If you're in your 20s or 30s, retirement may seem a little too far off, and it's easy to shrug it off with, I'll think about it when I'm 40. But there are two good reasons to start planning your retirement early. For one, you have fewer financial responsibilities. Now those go up once you hit 40. Then there's the aspect of time. The more time you give your investments, the more it grows, thanks to compounding interest. But as you obsess over returns, you don't want to forget taxes, which can and will affect the former. Which is why in today's video, we share 9 ultimate tax strategies to help you maximize your retirement savings, whether you're just starting your savings journey or nearing retirement. So like, subscribe, and buckle in for the ride. As with your income and everything else about your money, the government will want a part of it. And it can feel like you don't have control over how much or when the IRS takes what they feel is duly owed. But believe it or not, you actually have more control than you think. In fact, you can control how much tax you pay on your retirement savings more than anything else. And it's never too late to implement some of these strategies. So first on the list is number 1, max out your retirement work plan. Now, the first and easiest tax strategy for maximizing your retirement savings is maximizing or maxing out your employer-sponsored IRA. Now, the 401k is the most common employer-sponsored retirement plan. This plan, exclusively offered by employers to employees, allows you to save and invest your pre-tax income towards your retirement, with the tax being deferred. So you pay 0 taxes on your contributions now, and those contributions grow tax-free until you retire at 59.5 and consecutively start taking contributions. This is when you pay your taxes. Now, as of 2024, the IRS maximum contribution limit for employees is $23,000, up $500 in 2023. So unless you're 50 years or older, in which case you can contribute as much as $30,500. By maxing out your contribution limit, you're not only reducing your tax bill for the year, but you're also accelerating your savings potential growth multiple fold. Compounding will do the rest for you. Number 2, additionally, you should get a Roth IRA. Yes, you can have and should have more than one retirement account if you can afford to. Unlike a 401k, which is tax deferred, Roth IRA contributions come from your after-tax income. So, however, they will grow tax-free until retirement. And once you retire, you can take withdrawals, which includes what you contributed plus earnings tax-free. Now, a reasonable investment strategy is to max out your 401k and then invest the remaining disposable income in a Roth IRA. This strategy gives you the most dollars after tax in retirement. Of course, you have to be eligible under the IRS guidelines. That's because a Roth IRA has a maximum income limit of $161,000 for single filers and $240,000 for those filing jointly. Now, note that these are 2024 figures. Now, I want you to also note that these are 2024 figures, so making sure that you are up to date for your contributions for this year. Make sure you take advantage of these numbers as well. Number 3 is, if you don't qualify for a Roth IRA, consider a non-deductible IRA. As your income rises, you would understandably want also to increase your retirement savings. After all, more savings means more financial comfort when you no longer work. However, there's one issue. There's a limit as to how much deductible income you can contribute to a 401k or any other traditional IRA. Anything above this limit is not tax deductible. This means you can only contribute after tax dollars beyond the set limit for that year. And the alternative, which is a Roth IRA, has income limits that basically locks out high income earners. But there is a way you can work around this. You can make non-deductible contributions to your IRA and then later convert those contributions to a Roth IRA. This way you can enjoy tax-free growth as well as tax-free withdrawals upon retirement. This is what's known as the backdoor Roth IRA. Remember, with the convention Roth conversions, you pay tax at the time of the conversion. Number 4 is consider a Roth conversion. You might want to move your traditional retirement savings into Roth IRAs. This way, when you retire, you won't have to pay taxes on the money you take out. But keep in mind that you'll have to pay income tax when you move that money. However, after 5 years, you won't have to pay taxes on future withdrawals. Now, if you think your tax rate will be higher when you retire, converting your retirement savings to a Roth IRA could be a smart move because Roth IRAs are already taxed. It can help you lower the taxes you pay in retirement. Another good thing about Roth IRAs is that you don't have to take out a minimum amount each year. You can take out as much or as little as you need during retirement. Number 5 is get a health savings account, otherwise known as a HSA. Old age often comes with more medical bills. One way to cushion yourself for this is to have a health savings account. When you put money into a HSA, you can deduct that amount from your taxable income when filing your tax returns, therefore reducing your tax bill. How much you can put into a HSA depends on the type of health insurance you have. The rules can change each year, so it's good to check with your financial advisor or look on the IRS website to see the current limits. The best thing about an HSA is that when you take money out for medical expenses, you also don't have to pay taxes on it. This includes things like deductibles, co-pays, and prescription costs. Number 6 is don't forget to harvest your losses. At the end of the year, it's a good idea to check if your investment plan still matches your goals. When you do this, you might find a way to lower your taxes you owe by using something called harvesting losses. So here's how it works. If you made money on some investments, capital gains, you can balance that out by selling other investments that have lost value. This can help lower the taxes you'll owe on your gains. You can even use losses to reduce your taxable income by up to $3,000 if your losses are bigger than your gains. But you need to watch out for the watch sell rule, which says that if you sell an investment to harvest a loss, you can't buy the same or very similar investment within 30 days. If you do, you might lose the tax benefits. Number 7 is look at your tax credit and deduction options. Even in retirement, you might still have to pay taxes, but there are ways to reduce what you owe. When you're 65 or older, the IRS gives you a bigger standard deduction, which means less of your income is taxed. Depending on how much money you make, you might also qualify for a tax credit if you put money into a retirement account. There are other ways to lower your taxes too. You can list out your deductions like charitable donations and take advantage of tax credits like ones for education or saving energy at home. By taking a closer look at all the tax deductions and credits available to you, you can come up with a plan to pay less in taxes. Number 8 is always take your required minimum distributions. Once you hit around age 72 to 73, you'll have to start taking money out of your IRA and 401k accounts. This is called a required minimum distribution. When you take this money out, you'll have to pay taxes on it. If you don't take out the required amount, you could face a penalty fee up to 25% of what you should have withdrawn on top of the taxes you owe. To avoid getting hit with a big tax bill, it's essential to plan for RMDs during retirement. You can lower the amount of money that's taxed by converting some of your IRA to a Roth IRA, giving money to charity, or buying a life insurance policy for your loved ones. Number 9, finally and most importantly, having a withdrawal strategy. Now, if you've sacrificed a lot over the years and stayed committed to making as much in retirement contributions as possible, finally you've reached the retirement age and qualify for withdrawals. The hard part is done and it's time to enjoy the fruits of your labor. Well, not really. The truth is, you can still make mistakes at this point that will see you paying a higher tax bill. That's why you need a withdrawal strategy for your various accounts. Instead of withdrawing randomly from all your accounts as your needs demand, one simple yet efficient strategy is to withdraw from the taxable accounts first, that is your 401ks or similar. This way you're spending the taxable assets first, then move on to your tax-free accounts like the Roth IRAs. This simple move can save you thousands of dollars in taxes in the long run. As you can see, the more tax strategies you know, the more you can save and the more you can grow your retirement savings. So which one of these tricks are you going to be using? Drop a comment, and while at that, like and share. We have more tax tips coming soon, so remember to hit that subscribe button, and also thanks for watching.